Today, we're speaking with Andrew Lockhart, CEO and Managing Partner at Metrics Credit Partners, one of Australia's leading private market asset management firms, providing loans to corporate and real estate borrowers across Australia and New Zealand. Metrics manages a range of funds, including the ASX-listed Metrics Master Income Trust, ticker MXT, which focuses on delivering regular monthly income from a diversified portfolio of corporate loans. Andrew, welcome back.
Hi, Lauren. Nice to be here.
For someone hearing about the Metrics Master Income Trust for the first time, how do you explain what it does and who it's designed for?
MXT is really designed to give investors exposure to a diversified portfolio of Australian corporate borrowers. And so if you think about the market, Australia is very much a bank-dominated market. When companies and others want to borrow money, they go to the bank. And it's really very difficult for investors to gain exposure to a diversified portfolio of corporate borrowers. We don't have a deep bond market of any size or scale. And so most investors looking to think about how they manage their defensive part of their portfolio have limited options. And so when we launched MXT back in October of 2017, it was designed to give investors exposure to effectively the same assets or the kinds of assets that a bank would hold on their own balance sheet. And so in MXT, we do a number of things. We lend money for both publicly and privately held corporates. We lend for real estate purposes. We're active in project and infrastructure funding and also what we refer to as acquisition financing. And so if you think about it, the companies that we lend to, the debt is a lower risk position than equity in the capital structure. And so the shareholders of all of those individual companies contribute their equity. Our role is to source and originate good quality transaction opportunities with those companies, to structure the appropriate terms and conditions, set the covenants, take the security, and negotiate the price outcome. And then when you put that into a well-diversified portfolio, you're actually lowering investor risk, because the greatest risk that an investor is really exposed to is the risk of a default of a borrower, which might result in a capital loss. And so a well-diversified portfolio reduces that risk. So when I think about it in terms of what investors are looking for, it's really for those investors that are looking for a defensive allocation, an alternative to traditional fixed income, an alternative to hybrids. And the beauty of MXT is because it's listed on the stock exchange, investors can quite clearly see what is the return objective of the fund. So the return objective is the RBA cash rate plus 3.25% net to investors. Income's distributed monthly. And so we've got an indication as to the return. The risk profile is predominantly senior secured, diversified portfolio of Australian corporate borrowers and projects. And then, of course, the beauty of MXT is the fact that it can be bought and sold and traded on the exchange. From an investor looking for a higher return from private debt in a liquid format, MXT is a very attractive investment because of the fact that it can be bought and sold and traded over the exchange in a secondary market.
So MXT's objective is monthly cash income with the target return of the RBA cash rate plus 3.25% per annum net of fees. In today's environment, what sort of income are investors actually seeing, and how consistent has that been over time?
Well, we launched the fund back in October of 17, and we've exceeded that minimum target return since the day the fund is listed. And one thing we're conscious of is that you're not looking to increase the risk profile to an investor. It needs to be consistent. The beauty of MXT is when we first launched it back in October of 2017, it was diversified across 55 loan positions. Today, close on 350 positions. The target return, the RBA cash rate plus 3.25% net. We've exceeded that. I think over the last number of years, the since inception returns are around 4.4% over the RBA cash rate, so exceeded that minimum target return. We've also taken the opportunity as the fund has grown to lower the costs to investors. So the total MER or the management expense ratio has reduced since the IPO, so that we've delivered a better return for our investors, partly because we've also been able to lower the cost. And as a result of that, the fund has gone from an initial raising of 500 million to now close to 2.5 billion, and provided diversification across a very strongly performing portfolio. And the beauty of it, again, is the fact that that income has been distributed each month from a well-diversified portfolio of borrowers, and the fact that our investors can buy and sell easily on the exchange. And so they've got control over that liquidity risk that is often something that people worry about in a private market investment fund.
So when investors buy MXT on the ASX, what are they really getting exposure to? Can you paint a picture of the types of borrowers and deals in the portfolio today?
We lend to a range of different corporate borrowers. So we lend to publicly listed companies. Companies like Woolworths, Origin Energy, Brickworks are examples of companies that we've lent to. We're active in real estate financing. So again, Australia has a strong need for residential housing, and so we've been very active in high density residential housing, predominantly in Sydney. About 60% of our portfolio is invested in metropolitan Sydney high density residential. Could be land subdivisions out at Orchard Hills. It could be a high density apartment building being built at Westmead, for example. We're also very active with a lot of private equity firms where they're acquiring businesses. And so, some of the well-known firms like KKR, EQT, Bain, together with a whole range of Australian private equity managers, Quadrant and Next Capital and others, we've supported those firms where they've been buying companies, and we provide what we call acquisition financing. So that's against the company's cash flow that will service and repay our debt. A lot of people know of companies like Arnott's Biscuits, for instance. That's an example of a leveraged finance transaction that was completed some time ago for KKR. We're also heavily involved in project and infrastructure funding. So things like the WestConnex project or the Sydney desalination plant, the Victorian desalination plant, even the Perth football stadium were projects that we've been involved in providing funding. So across that market, we're lending directly to a whole range of different companies that are well diversified. We've tended to stay away from companies that are active in the natural resources space or in agriculture. And the reason for that is we're looking for companies that can generate consistent, stable cash flows. And so when you think about some of those other industries in Australia, you might have more volatility around commodity prices or production volumes. You might have foreign currency risk. You could have trade disputes or tariffs that could impact the performance of those companies. So as a lender, we're not looking to generate an equity return. We're looking for companies that can generate consistent, reliable cash flows to be able to service and repay their debt obligation to us. And so that's the kind of companies that we're involved in. We do tend to stay away from those industries that are more cyclical. You've got more volatility around cash flows, but it's primarily Australian and a little bit of New Zealand-based companies.
So investors like the income, but they worry about credit risk. So what are the key ways you manage the risk of loss? Things like security, covenants, diversification, and ongoing monitoring.
I think it's really important. In fact, one of the call-outs that ASIC had in their most recent report was the management of credit risk. And so one of the things I think is really important is to look at the track record and history of the team. What is the due diligence that they undertake? How successful have they been? So you look at Metrics Funds, we're the largest private credit provider in the Australian market. We launched our first fund in June of 2013. Myself, my partners, and today we have over 500 people in the Metrics group working in our business. So we're a well-resourced, highly credentialed team that undertake deep, fundamental, bottom-up credit analysis and risk assessment. But we're also very active in terms of how we engage with our clients. We want to do business with good quality companies, good quality real estate providers and others, where we know them, we've got a trusted relationship, and we get access to private, confidential information that allows us to assess the risk. So what we're doing in all of those circumstances is your first primary obligation is you look at the industry, you look at the management team, you look at the way in which that what is going to drive the cash flows they're going to service and repay the debt. So for instance, if you think about a residential development project, it's on completion of the construction and the sale of the apartments in that building, that's the source of repayment to repay our debt. So you have to do a lot of due diligence around, are you comfortable with the market risk? Are you comfortable with the construction risk? Are you comfortable that, the client can build on time and on budget to deliver the completed building? So for us, it's a very deep dive into all of that. We analyze and stress test all of that through different markets. And what we're really looking to do is understand, is there a point where the deterioration of the performance of a borrower could wipe out equity and we might be exposed to the risk of loss? And then obviously we have a very significant and experienced team that are then responsible for the ongoing portfolio risk management. But it is about negotiating with the right counterparties, the right companies you want to lend to, appropriate terms, conditions, negotiate the appropriate structure. What is the appropriate level of debt that the company or the project can sustain? Ensuring you then have appropriate controls to monitor that risk. And of course, you take security that gives you the protection that if something goes wrong, you've got the ability to take control of the asset to give you options to avoid taking a loss.
So most of MXT's loans are floating rate. What has that meant for investors as rates have moved, and how should people think about distribution levels if rates stay where they are or eventually fall?
What we look at is what is a sustainable excess return that can be delivered over the RBA cash rate. So if you think about it, the RBA cash rate is reducing because economic growth might be slow, in which case, investors are, seeing a reduction in the returns they might be receiving from the companies they've invested in the equity because the dividends might be impacted. And so that ability to move both up and down is really a hedge against future inflation. If the economy is roaring along and the Reserve Bank wants to slow economic activity or inflation remains high, then the lever they use is interest rates. And so it's a real hedge against inflation in that regard. So what we think about, though, is the excess return that can be generated. So if you look at, deposits and you look at hybrids and you look at corporate, government bonds or other bond instruments, what tends to happen is investors might be gaining exposure to high investment grade exposure where the excess return over the RBA cash rate is quite low. So what we're looking for is there's suitable lending opportunities where we can protect our investor capital through appropriate terms and conditions, the covenants and the security, but also provide our investors with a full return. The fees that can be generated by lending to companies together with the margin, and that can provide a total return. But if interest rates move, then the total return that an investor will have will either go up or go down. So when interest rates were at 10 basis points in the middle of the pandemic, we were still delivering around 4.5% plus extra return over that RBA cash rate. So it's still an attractive return in comparison to other asset classes at the time. Then when interest rates rose to 4.35% and you're still getting 4% plus as the extra margin, then you're generating a high return. So if you think about it, if you look at a bank profit and loss report, they'll talk about the NIM that can be generated, which is the net interest margin. And if you're thinking about what we're delivering to our investors, we're really delivering the full NIM. There's no cost of funds because our investors have invested equity. So we're delivering the full return and then less our management fee. And so investors are getting a very attractive return across a well-diversified portfolio. But it does move up and down depending on the fluctuations of the underlying RBA cash rates.
So what are the key benefits, structural features and risks of gaining exposure to private corporate loans via an ASX listed trust such as MXT?
Well, when we've established products for clients, we've always looked at it on the basis of what is our client's return objective? What risk do they need to take to achieve that return? And then what are the ways in which they can control their need for their capital? So what's the liquidity parameters? And so with MXT, we designed the product to provide investors with a well-diversified exposure to private credit investments, delivering what we think is a sustainable excess return over the RBA cash rate over the longer term. And so when we launched back in October of 17, the fund was diversified across 55 individual loan assets. Today, it's close to 350. And so what that's done is it's lowered investment risk for investors as they're taking less risk against any individual company or project. So a well-diversified portfolio of holdings lowers investment and credit risk. but we've been able to maintain a very attractive spread of like over 400 basis points over the RBA cash rate. And so the benefit for investors is you're getting an option around where to allocate as a defensive allocation in a portfolio. So private debt, in my mind, provides all of the characteristics around capital stability. The manager can demonstrate that they are taking action through appropriate terms, conditions, covenants, the taking of security, ways in the capital structure are designed to preserve investor capital. So it can be a defensive investment, but it becomes a very defensive or very attractive portfolio allocation when you can gain exposure to well-diversified pools of investments. And then the beauty of MXT is you've got that defensive allocation, monthly income distributions with full control over when you decide to buy or sell to protect your capital. And at the moment today, unfortunately, we've seen a dislocation in the price of MXT. It's trading below the quoted NAV, which that suggests to me that that's an opportunity for some people to consider whether or not it might be an opportunity to acquire. But one of the things that we've been clear about is to provide investors with detailed portfolio disclosures. And so we issue a regular quarterly disclosure that provides investors with all of the key risk parameters. One of the things that ASIC has looked at in its most recent report was the level of disclosure that was available to investors to inform them as to what the risks and the returns of the product was. And so you can acquire units in MXT, you can see the quarterly disclosures that are available, and you can go back over a time series period of over 5 years and see how the fund has performed and tracked all of the key data points. What's the level of interest arrears? How many loans have you enforced EAs? How much have you lost? What are the fee rates? All of that information is disclosed on a quarterly basis.
And what are the most common misconceptions about private debt, and how does MXT's portfolio construction and risk management address them in practice?
I think one of the biggest misunderstandings in private debt is this idea that it's a homogenous market, that all investments and all managers behave and operate the same way. At the end of it, investors may have a high risk or a low risk position, in which case the manager's obligation is to inform investors as to what is the risks and the potential returns that they're exposed to. I think importantly, what we've tried to do with metrics is we've tried to segregate a range of products so that investors can clearly see through the target return what the change in a potential risk profile will be. We don't bundle all of our investments into one. And so I hear a lot of comments where people say, oh, private credit, they're the companies or projects that the banks won't lend to. That's not the case. There are quite a number of the companies that we lend to that are publicly listed on the stock exchange where, the banks are working alongside us to provide financing to those companies. Similarly, across our whole range of property, real estate related borrowers and the like. Our role is to really help investors understand the way in which we originate transactions, the way in which we manage the risk associated with those, and how we try to protect and preserve investor capital. Our role is really to ensure that our investors are getting the benefit from well-diversified portfolios. So I think there's misunderstandings that private credit's the lender of last resort. We're lending where the banks won't go. The beauty of private credit is really our investors don't benefit from the financial claims scheme. Our investors don't benefit from the liquidity provided by the RBA. So we are totally answerable to our investors for the risks and returns that we deliver. And so importantly for us, we want to manage the investments in line with the fund mandates, and investors have a range of choices. Some might want the lower risk defensive allocations. Some might want higher returning, total returning assets where they've got some equity upside. So again, I think it's really important that private credit managers disclose the potential risks and returns to investors through their disclosure documents, and then maintain a very clear discipline in terms of, this is what this fund does and this is what it's invested in. So it fits well within a client portfolio.
Andrew Lockhart, thank you for your time.
Thank you, Lauren.